You'll often hear accountants say you can take £100,000 from your company and pay as little as £6,500 in personal income tax, but they're forgetting one important factor: corporation tax. You see, to take them funds from your company, you have to have made a level of profit to be able to extract them as retained earnings or dividends, which means that corporation tax must have been payable previously on that funds for you to be able to do that. So we backworked it to see what's the true total tax bill of drawing that amount. So the most tax efficient way of drawing generally is a 12.5 grand salary. The remainder is dividends to take yourself up to a 50k threshold. If there's two of you, you split that with a spouse, and that's where they're referring to draw £100,000 out between the two of you. 6.5 grand self-assessment tax bill. The issue is to draw 37,413 dividends each. You need a profit after tax of 74,860, which means you need a profit before tax of 96,749. Corporation tax payable on that, 21,888. So what this essentially means is you have to take into consideration the corporation tax that was due on the profits before you draw on the dividends, and the personal income tax once you've taken it from your limited company. Adding them two together gives you total tax of 28,485 to be able to get net drawings of 93,404, which is essentially 100 grand less the self-assessment tax bill that would be due on that, to give you true net earnings into your personal pockets. So whilst it may seem cheap, you've also got to pay a load of corporate tax, which does bump up the true tax bill. So it can be a bit of a fad, but we've compared that to sole trade or a partnership to keep it fair, where there may be two individuals that can claim and utilize their basic bands and personal allowances. So just out of interest, really, just to see how different it actually is, which means that we need a profit after tax figure of 46,701, which is going to give us our net drawing. So to achieve that, we need a profit before tax, 61,017. The tax deductions are listed here. So we've got 11 grand of income tax, 2,400 of national insurance, gives us total tax per individual 14,315. Times that out by 2, we've got 28,630 total tax to get to the same level of net drawings as if you were limited. Now, the surprising factor here is the fact that there's only £200 difference in these calculations, which is astonishing, really. We're seeing the government probably in the last few years take away sort of any edge or advantage tax-wise between the two legal entities. There still are different reasons why you should choose each. So, for example, sole trader might suit you for simplistic terms if you're a stable business, but you're not necessarily going over 50k in profits consistently year on year. Whereas a limited structure would definitely benefit you if you're planning to grow, expand. You've got the limited liability protection, but you see the tax advantages start to kick in really once you cross sort of the 50k net profit, and if there's only one of you there, then you can't split your income like we did in that scenario. So yeah, I just thought it'd be interesting to run through and just sort of debunk the 6.5 grand tax on the 100k drawings.